Hi and welcome to Market Watch. Wall Street is jittery again. It's time to take a look at what has spooked markets. With me I have Pi Fund CEO Mike Taylor. Mike, what has spooked markets this week?
Yeah, hi Liam. It seems to be once again interest rates, and in this case it's what we call the yield curve inversion. So for those who don't know what that means, it means when long-term interest rates and short-term interest rates are basically the same, or long-term interest rates go below short-term interest rates. Why that's really important for markets is because the yield curve has predicted or preceded every recession since World War II.
So does this mean people think we've got a recession coming?
Well, that's what the bond market is telling us. And the saying is that the bond market is more intelligent than the stock market, and we don't really know why that is, but that's what the saying is. So in this case, the bond market is telling us, based on past experience, that a recession could come between 6 months and 24 months in the future.
So that's a very broad time frame to deal with, particularly when you consider that we are looking at what could be the longest US, post-war US economic expansion, in terms of length into 2019.
Yeah, in June or July this year, I think the expansion will, if it continues to then, will be the longest in history. One of the things though this time is that central banks are probably a lot more proactive than they've been in the past. I think previously, in previous cycles, central banks have always trying to put a lid on inflation and been very fast to hike rates and hold them up there. Whereas this time the perception is maybe that they're being proactive and they're actually looking to talk interest rates down and give the market or investors and borrowers some more breathing room quickly, which they haven't done in the past. Where
does that leave you, from an investor point of view? Because obviously it's a dilemma for fund managers, dilemma for all investors, and you've talked about this before, about holding cash. Do you start to take a more defensive approach and start to sort of pull back, almost in anticipation of something dropping off?
Well, the first thing to do is actually look at the data, not necessarily look at what the Fed's doing. And the data is saying that the global economy is slowing. Manufacturing numbers all around the world are pulling back. So the first thing we know is that world growth is slowing. We also know that earnings growth is slowing. So, these central banks are only moving for a reason. They're not just doing this sort of out of thin air to be kind to investors.
We have these other things that we talk about a lot, your Brexit, your trade tensions with US and China, and issues in Europe and other parts of the world. How much do they play into all of that strategy?
Well, it's all uncertainty, and markets and investors hate uncertainty, and the longer it sort of goes on, the more worried investors become. And actually it's funny is that all they really want is an outcome, and they can deal with whatever the outcome is. They just want to know what the outcome is. So the longer the uncertainty goes, the more it weighs on markets, obviously, and in that case it does play a bit more defensive until you have an outcome.
So when you look at all that, you step back, you look at maybe the possibility of a recession as far away as 2 years or something like that. What would a downturn look like to you? How would that play out? What's a likely scenario?
Well, the interesting thing, I guess, is that if the central banks have been much more proactive than they've been in the past, potentially the slowdown is quite slow. It's not sort of a fast off the cliff as we've seen previously. So if the Fed's sort of cutting rates, the ECB stimulate again, same with Bank of Japan, maybe it'll just be sort of a slowing of growth back to sort of 0 to 1%, rather than a sort of we go at 3 and then suddenly we're at -3. So that kind of feels like how the situation might play out. In which case, if that does happen, we'll see volatile, choppy markets where it's down 20, up 20, as sort of news gets fed into investors.
So, if we had a long, flat, stable period, I guess the question is, where does the money go? For example, if you had 10 years of not much growth coming out of Wall Street, where would you start to look?
Well, I guess you would want to take advantage of the sell-offs when people, throwing the baby out with the bathwater, and then certainly take profits again when markets rally back. I would be concerned over areas that have frothy valuations and wouldn't want to be holding those particular investments when things slow. Markets always suddenly decide to look at valuations again and go, actually, well, maybe that thing's overvalued, and those particular names, such as we saw in the dot-com crisis, can correct very heavily. So avoid names like that and go more to value.
So look, with the Fed pulling back, it looks like interest rates stay low for longer. That does mean less returns for bank deposit rates. So do you think that could flow back into markets?
Yeah, I mean, if for bondholders or people in deposit markets, we're faced with that similar scenario we did maybe 5 years ago is, what's the alternative? I need to earn a return. You know, global pension funds have a target of return of 7.5%. They're not going to get that from investing in US Treasuries or even New Zealand government bonds, which have just hit a record lowest level since 1985. So you've got to go and hunt for yield and return. And then again, that forces people back into equities, because that's where they can get a dividend yield, or that's where they can get capital growth.
And I guess we are seeing that story play out in New Zealand as well, where the markets have again hit new highs, awful little this week, but certainly a lot of money underpinning the value there.
Yeah, I mean, unless, as we say, unless there is a very deep recession and company earnings fall off a cliff, then people will be forced into the equity market to get that kind of return. You know, if we're in a scenario where rates are low, growth is sort of zero, but earnings is flat, then people have to go to equities.
So I guess I ask you this every month, Mike, but if things stay the same, there is no reason for an impending crash?
No, there's no reason for an impending crash, but these things can come out of anywhere. So, as we say, we never know. The future's uncertain.
As always, touch wood. Thanks for that, Mike. We'll leave it there. Cheers.